There's a piece of financial advice that has been repeated so often, and for so long, that most people treat it as settled truth. Just put it in the S&P 500 and leave it alone. It's the advice that fills personal finance books, Reddit threads, financial planning conversations. It's what people say when they want to seem sensible about money. And for a very long time, for most of the last 30 years, it was genuinely excellent advice. This episode is not about telling you it was wrong. It's about asking a question that doesn't get asked enough. What conditions made it right? Are those conditions still in place? And what does it mean if they're not? Not financial advice, a clearer picture, which is always the starting point for better decisions. Ready to take your first real step? Get the guide, Buying Your First Bit of Bitcoin, $15, link in the description. First, what is the S&P 500 for anyone who needs a quick grounding? The S&P 500 is an index, a collection of 500 of the largest publicly traded companies in the United States. Apple, Microsoft, Amazon, Nvidia, plus 496 others. When you buy an S&P 500 index fund, you're buying a tiny slice of all 500, automatically diversified across the largest companies in the world's largest economy. The argument for it is compelling. Rather than trying to pick individual stocks, which most professional fund managers consistently fail to do better than the index, you just own the whole market. Low fees, no guessing. Set it and forget it. Warren Buffett has endorsed it. John Bogle built Vanguard around the principle. Generations of financial advisors have recommended it. And the track record, historically, is genuinely impressive. So what's the question? The question is about conditions. The S&P 500's extraordinary performance over the last 3 decades happened during a very specific set of circumstances. Interest rates that fell steadily from the early 1980s all the way to near zero by 2020. Globalisation that dramatically reduced the cost of producing goods. A technology revolution that created entirely new industries and revenue streams. And after 2008, an extraordinary era of cheap money that pushed investors into stocks because nothing else offered a return. Those conditions were not permanent, and they are no longer in place. When a financial advisor says, just put it in the S&P 500, they're making several assumptions, most of them unstated, some of them no longer clearly true. The first is diversification. The S&P 500 is supposed to be diversified. 500 companies across many sectors. But diversification is not the same as equal weighting. The index is weighted by market capitalization, which means the biggest companies make up the biggest slice. Right now, the top 10 companies in the S&P 500 account for roughly 35% of the entire index. Most of those 10 are in technology, which means owning the S&P 500 is actually a significant bet on a small number of tech companies, whether you intended it that way or not. That's not necessarily wrong, but it's different from what many people think they're buying when they hear diversified index fund. The second assumption is returns. The S&P 500 has historically returned around 10% per year, on average, over the long term. That number gets quoted constantly. What gets quoted less often is what happens when you adjust for inflation and tax. 10% minus 4% inflation equals 6% in real terms. 6% minus capital gains tax. The rate varies by country and income. Leaves something smaller still positive, still meaningful over decades, but a different number from the headline figure that gets repeated most often. And that 10% historical average includes periods of extraordinary tailwinds that may not repeat in the same way. Which brings us to the tailwinds. The conditions that drove S&P returns for 30 years are now running in reverse. Interest rates rose dramatically from 2022 onwards, the fastest rate cycle in 40 years. Globalization is fragmenting under geopolitical pressure. Supply chains are being rebuilt domestically or regionally, which is more expensive. Inflation has returned after 2 decades of near absence, and the cheap money era that pushed everything into stocks is over, at least for now. None of this means the S&P 500 will perform badly. Markets are complex, adaptable, and have surprised pessimists many times. But it does mean the argument, it always goes up over the long term, deserves more scrutiny than it usually gets, because the long term in that statement is doing a lot of heavy lifting. Let's get more specific about the shifts that serious analysts are paying attention to. Interest rates changed everything. When rates were near zero, which they were for most of the period from 2008 to 2022, stocks were essentially the only place to get a meaningful return. Bonds paid almost nothing. Cash sitting in a savings account lost value to inflation. So capital poured into equities, pushing prices higher. When rates rise, that calculus changes. Bonds start yielding something real. Cash becomes less punishing to hold. And stocks, particularly growth stocks valued on future earnings, become relatively less attractive. Not necessarily bad, just different. And the S&P 500's last decade was built in a world that no longer fully exists. Currency risk is another factor that rarely gets discussed, but matters enormously for anyone outside the United States. The S&P 500 is priced in US dollars. If you're in Australia, the UK, Europe, or anywhere else, your returns are affected by the exchange rate between your currency and the dollar. A 10% gain in the index can be partially or fully offset by a movement in the currency pair. Add inflation on top of that, and the headline 10% return starts looking more complicated. Not necessarily bad, but something worth understanding clearly, rather than assuming away. And here's the framing that matters most. The advice to put everything in the S&P 500 was genuinely excellent for the conditions it emerged from. For most individual investors, most of the time, a low-cost index fund has outperformed active management. That's still largely true. But conditions change, and advice that doesn't update with conditions becomes dogma rather than strategy. Questioning it isn't pessimism. It's what financially literate people do when the world around them changes. This episode isn't recommending Bitcoin as an alternative to the S&P 500. They're different assets with different risk profiles, different histories, and different roles they might play in a financial life. But here's what's relevant. Bitcoin's price doesn't move in lockstep with the S&P 500. The correlation between Bitcoin and U.S. equities has varied over time, sometimes higher, sometimes lower, but they're driven by fundamentally different things. The S&P 500 reflects the earnings and valuations of 500 companies. Bitcoin reflects something different. Demand for a fixed supply, decentralized form of money, in a world where the supply of traditional money keeps expanding. Those are different bets, different risks, different potential outcomes. Understanding both, clearly, without conflating them, is what good financial thinking looks like. The question this episode is really asking isn't S&P 500 or Bitcoin. It's, do you understand what you own? Do you know what conditions your investment strategy assumes? Do you know what changes would challenge those assumptions? Do you understand the difference between nominal returns and real returns? Between diversification as a concept and concentration as a reality? The advice, just put it in the S&P 500, contains a lot of unstated assumptions. Understanding those assumptions and deciding whether they apply to your situation is the difference between following advice and making an informed decision. That's true of the S&P 500. It's true of Bitcoin. It's true of every financial decision you'll ever make. None of this is a recommendation to change what you're doing. Please speak with a qualified financial advisor who understands your full situation before making any investment decisions. What this is the kind of conversation that should happen more, where the assumptions behind common advice get named clearly, where conditions get examined rather than assumed to be permanent, where you leave with a more complete picture than you came in with. That's what this channel is for, on every topic it touches. Ready to take your first real step with Bitcoin? Buying your first bit of Bitcoin is in the description, $15. Bitcoin for Girls, the building of a beautiful future. See you in the next one.